A Polish immigrant who coded algorithms at Google built an app that became America's third largest e-commerce platform. At its peak in December 2020, Wish was worth $14 billion. Peter Sulkowski, the founder, was a billionaire. The company had over 100 million monthly active users. It was the most downloaded shopping app in the United States. Investors compared it to Amazon. 4 years later, Wish sold for $173 million. 1% of its peak valuation. 99% of the value gone. Peter Sulkowski resigned. The stock trades for pennies. Monthly users collapsed from 100 million to 12 million. The company that once challenged Amazon now exists as a cautionary tale about what happens when your entire business model depends on something you do and control. This isn't a story about bad luck. This is a story about a business built on borrowed ground. A company that monetized other people's platforms without ever owning the foundation. And when those platforms changed the rules, the entire empire collapsed in 18 months. Let me show you exactly how it happened. How a brilliant engineer built a $14 billion company on rented land. How a single decision by Apple destroyed the business model overnight. And how every warning sign was visible years before the collapse. But investors poured in billions anyway. Peter Sulkowski grew up in Warsaw during the collapse of communism in Poland. His family immigrated to Waterloo, Ontario, Canada when he was young, escaping post-Soviet economic chaos for opportunity. He studied mathematics and computer science at the University of Waterloo, one of Canada's top engineering schools. That's where he met Danny Zhang, his future co-founder. In 2004, before graduating, Sulkowski landed a 4-month internship at Google. 23 years old. He coded in Palo Alto. The internship turned permanent. For 5 years, he worked as a Google engineer writing algorithms. Not just any algorithms. He prototyped the keyword expansion feature that helped advertisers find customers. The system that made Google billions. In 2007, Google sent him to South Korea to open a new office. The Korean market taught him something critical. Korean search portals were detailed, cluttered, visual, nothing like Google's minimalist Western design. Koreans wanted to browse, to discover. They didn't just search. They explored. That insight would become the foundation of Wish. But not yet. In 2009, Sulkowski had saved enough money to quit Google. He spent 6 months at home writing code, building something new, an ad recommendation platform that analyzed browsing behavior to predict interests. Better targeting, better conversion. The algorithm worked. He built Context Logic, a software company selling ad tech to businesses. September 2010. Context Logic raised $1.7 million from investors. Yelp CEO Jeremy Stoppelman backed it. Jerry Yang, the co-founder of Yahoo, invested through his fund. The pitch was simple. We've built an algorithm that outperforms Google AdSense by over 40% on click-through rates. Investors loved the technology, but they didn't love the business model. Selling ad tech to businesses is hard. Enterprise sales cycles are slow. The market was competitive. Then Facebook noticed. 2011. Mark Zuckerberg's team wanted Context Logic's algorithm. They offered $20 million to acquire the company and integrate the tech into Facebook's advertising system. $20 million. For a company 18 months old with barely any revenue. Sulkowski was 29. He said no. Some investors were furious. You turned down $20 million from Facebook? Are you insane? But Sulkowski had a different vision. He brought in Danny Zhang, his college friend from Waterloo, as co-founder. They relaunched the company, not as ad tech, as e-commerce. May 2011. They launched Wishwall.me, later shortened to Wish. The idea was simple but radical. Instead of search-based shopping like Amazon, Wish would be discovery-based. You open the app. It shows you a visual feed of products personalized to your browsing behavior, just like the Korean portals Sulkowski studied. You scroll, you discover, you buy. Like Instagram for shopping. Except the products cost almost nothing. Here's the model. Wish didn't sell products. Wish connected buyers to Chinese manufacturers selling directly. No middleman. No inventory. No warehouses. Chinese factories listed products on Wish. Customers in America scrolled, clicked, ordered. Wish took a commission, usually 15 to 20%. The products were absurdly cheap. Phone cases for $1. Dresses for $3. Gadgets for $5. Shipping took weeks, sometimes months. But the prices made people willing to wait. And Wish had a secret weapon: Facebook advertising. They used the algorithms Sulk-Suski built at Google to target Facebook users with laser precision. Cost-conscious shoppers, people who clicked on discount offers, lower-income households underserved by Amazon. Wish spent heavily on Facebook ads. 60 to 70% of revenue went to marketing. But it worked. The customer acquisition math was profitable. Spend $10 on ads. Acquire a customer. That customer spends $20 over their lifetime. 15% commission equals $3 gross profit. Lose $7. But scale it. Millions of customers. The loss is narrow. Then you break even. Then you make money. That was the plan. By 2013, Wish made the full pivot from wishlist app to e-commerce marketplace. Merchants could list products. The algorithm personalized feeds. Facebook ads brought users. The flywheel started spinning. 2017. Wish became the most downloaded e-commerce app in the United States. Not second, not third, first. More downloads than Amazon's app. By 2018, global revenue hit $1.9 billion. The company was valued at $11.2 billion after a Series H funding round led by General Atlantic. Peter Sulk-Suski was on Forbes' list of billionaires. At 37 years old, here's what made Wish different. Amazon served everyone. Wish served the invisible half. Cost-conscious consumers. People earning below median household income. People for whom $5 dresses and $1 phone cases mattered. People stretching paychecks between rent and groceries. Silicon Valley VCs had told Sulk-Suski this market didn't exist, wasn't worth serving, couldn't scale. They were wrong. Wish targeted the median household income and below. Over 1 billion households globally. Amazon catered to wealthier customers who wanted fast shipping and brand names. Wish gave you cheap goods from China with slow shipping. Different market, different value proposition. And for years, it worked. By 2019, Wish was America's third largest e-commerce platform by sales, behind Amazon and eBay, ahead of Walmart's online division. The app had over 100 million monthly active users. 5 million people visited the site daily. Investors were ecstatic. This was the next Amazon, except focused on value shoppers. The untapped market. December 16, 2020. Context Logic went public. NASDAQ ticker, Wish. IPO priced at $24 per share. The company raised $1.1 billion. Valuation, $14 billion. Peter Sulk-Suski owned 18%. Billionaire confirmed. Danny Zhang owned 4%. Early investors from Formation 8, Founders Fund, GGV Capital, they all cashed out portions at massive returns. Opening day, the stock dropped. It opened at 22.75, down from 24. By close, down 16%. Worst performing major IPO of 2020. Analysts said investors were nervous. Wish wasn't profitable. It spent massive amounts on Facebook advertising. User growth was slowing. There were quality complaints. Counterfeit products. Items not as pictured. Shipping delays. But Sulk-Suski told investors not to worry. Wish had a plan. They would improve logistics, tighten quality control, expand beyond cheap goods. The revenue was there. $1.9 billion in 2019. $2.5 billion in 2020. Growth was real, except it wasn't. The growth was an illusion, and the foundation was about to collapse. April 26, 2021. 5 months after the IPO, Apple released iOS 14.5, a software update for iPhones. Buried in the update was a feature called App Tracking Transparency. Every app that wanted to track users across other apps and websites now had to ask permission. Explicitly, a pop-up appeared. Allow this app to track your activity. 2 buttons. Ask app not to track. Allow. 67% of users clicked Ask app not to track. 67% opted out. This was catastrophic for Wish. Here's why. Wish's entire business model was Facebook advertising driven by algorithmic targeting. They spent $600 to $700 million per year on Facebook ads. 60 to 70% of revenue. Those ads worked because Facebook tracked users across apps and websites. You browse cheap dresses on one site. Facebook knows. You scroll Instagram. Wish ads appear showing cheap dresses. You click. You download Wish. You buy? The tracking made the targeting scalpel precise. Apple's change killed that. 67% of iPhone users. Apple's user base skews wealthier, but still, were now invisible to Facebook's tracking. Wish couldn't target them effectively anymore. The ads stopped working. Click-through rates plummeted. Customer acquisition costs exploded. Spend $10 to acquire a customer? Now it cost 15, 20, 30. The unit economics broke instantly. Facebook warned advertisers this would happen. Zuckerberg publicly fought Apple, calling it anti-competitive. But Apple didn't budge. Tim Cook gave a speech about privacy. Consumers deserve control over their data. Facebook's business model was surveillance capitalism. Apple was giving users a choice, and users chose privacy. Wish's revenue collapsed. Second quarter 2021. Revenue dropped 12% year-over-year. Third quarter, down 31%. Fourth quarter, down 62%. Full year 2021 revenue, $2.09 billion, down 18% from 2020. But that was just the beginning. 2022 was the avalanche. First half of the year, revenue dropped 77% year-over-year to $323 million. Not billion, million. Analysts expected full-year revenue of $716 million, down 66% from 2021. The company that did $2.5 billion in revenue in 2020 was on track to do $700 million in 2022. 72% decline in 2 years. Monthly active users followed. 100 million users at the IPO. 44 million by the end of 2021. 23 million by mid-2022. 12 million by the end of 2023. 88% of users gone. The stock price mirrored the collapse. $24 at IPO. $5 by mid-2021. $1 by early 2022. 50 cents. 30 cents. By 2023, trading below $1. NASDAQ threatened delisting. Gross margins imploded. 63% in 2020. 53% in 2021. 33% in the first half of 2022. Wish tried to compensate by adjusting prices upward, recognizing more logistics revenue, offering subsidized shipping to compete with Amazon. Nothing worked. Peter Sulkowski resigned in November 2021, 11 months after taking the company public. He remained on the board but vanished from operations. Insiders said he stopped coming to the office after the IPO. The new CEO, Vijay Talwar, inherited a sinking ship. Talwar tried everything. Cut costs. Laid off 17% of staff. Focused on quality over quantity, blocking merchants selling counterfeits. Introduced Wish Local, a program where mom-and-pop stores became pickup locations for Wish packages. Tried to improve shipping times. Highlighted the company's $837 million in cash and no long-term debt. Reminded investors Wish still had millions of users. None of it mattered. The business model was broken. Wish existed to deliver targeted Facebook ads to price-sensitive consumers. Without tracking, the ads didn't work. Without ads, customer acquisition became impossible. Without customers, merchants left. Without merchants, the platform died. Competitors moved in. Pinduoduo launched Temu in 2022. Same model as Wish, Chinese sellers, cheap goods, but better logistics and quality control. AliExpress expanded in the US. Amazon's third-party marketplace already offered Chinese goods with Prime shipping. Wish had nothing unique left to offer. France banned Wish in November 2021. Regulators said the platform sold counterfeit goods and items violating European safety standards. Google delisted Wish from search results and removed the app from the French Play Store. The ban lasted until March 2023, but the damage was done. Trust evaporated. By 2023, Wish was a zombie. 12 million monthly users. $287 million in revenue for the full year, down from $2.5 billion 3 years earlier. The company was burning hundreds of millions annually. Cash reserves dwindled. The stock traded below $1. February 2024. Context Logic announced a deal. Wish, the e-commerce platform, would be sold to Qoo10, a Singapore-based e-commerce company. Purchase price, $173 million. $173 million. The company that IPO'd at $14 billion sold for $173 million 4 years later. 98.8% of the value destroyed. The sale closed in 2024. Context Logic kept the cash, the net operating loss tax carryforwards, and nothing else. The company still technically exists, but not as an e-commerce business. It's a shell holding cash and tax assets looking for acquisitions. Wish, the platform, now belongs to Qoo10. Here's what happened. Wish built a $14 billion business entirely dependent on Facebook's advertising infrastructure. Every dollar of growth required Facebook's ability to track users and target ads. Sulkowski knew this. Investors knew this. But they bet Facebook's model was permanent, that tracking and targeting would always be available, that the foundation was solid. It wasn't. Apple changed the rules with one software update. Not to destroy Wish. Apple didn't even think about Wish. Apple changed the rules because consumers wanted privacy and regulators were circling. 67% of users opted out of tracking. Facebook's ad platform degraded for everyone. But Wish was especially vulnerable because advertising was 60 to 70% of costs. When efficiency dropped by 30, 40, 50%, the math broke. Wish had no backup plan, no owned customer acquisition channels, no brand loyalty, no logistics infrastructure, no inventory. Everything was rented. The platform was rented from app stores. The traffic was rented from Facebook. The products were rented from Chinese merchants. When Facebook's value collapsed, Wish had nothing. Compared to Amazon. Amazon owns logistics, warehouses, trucks, planes, delivery networks. Amazon owns customer loyalty, Prime membership, repeat purchasing habits. Amazon owns data, direct relationships with buyers, not mediated through Facebook. When Apple changed iOS, Amazon barely noticed. Their model didn't depend on Facebook tracking. Wish depended entirely on tracking. It was the ultimate rented business. And when the landlord changed the locks, Wish was evicted overnight. But here's the part that should terrify anyone building a business in 2025. Every warning sign was visible before the collapse. Quality complaints plagued Wish for years. Customers posted photos of products that looked nothing like the listings. Counterfeit goods flooded the platform. Shipping took 8 weeks. Returns were impossible. The reviews were brutal. User growth stagnated in 2018. 100 million monthly active users in 2020. But LTM active buyers, people who actually purchased, peaked at 64 million in 2021 and started declining immediately. 61 million in Q1 2022. 20 million by Q2. Churn was catastrophic. Facebook dependency was obvious. The company disclosed in its IPO filing that 60 to 70% of revenue went to sales and marketing, almost entirely Facebook ads. Any analyst could see the risk. If Facebook ads stop working, Wish dies. Apple announced app tracking transparency in June 2020, 6 months before Wish's IPO. The threat was public information, but investors poured in $14 billion anyway. Why? Because revenue was growing. $2.5 billion in 2020. Because downloads were high. Because the story was compelling, serving the underserved, the invisible half, the anti-Amazon. Investors ignored the fundamentals. Negative gross margins in many quarters. Unprofitable at scale. Entire business model dependent on one advertising channel controlled by one company subject to regulation by another company. The Jenga tower was missing the bottom layer, and everyone pretended it would stand forever. It didn't. 18 months from IPO to total collapse. Peter Sulkowski walked away a billionaire on paper, though his stake evaporated with the stock price. Early investors who sold at IPO made fortunes. Late-stage investors and public shareholders were annihilated. The lesson here isn't don't use Facebook ads. The lesson is, never build a business where your entire model depends on infrastructure you do and control. Wish's success was rented. The growth was real, but it was borrowed growth. The moment the terms changed, the business evaporated. Every business built on someone else's platform is one policy change away from extinction. Wish proved it at $14 billion scale. The algorithm was brilliant. The targeting was sophisticated. The market was real. But none of it mattered because the foundation was rented ground. Amazon owns the foundation. Google owns the foundation. Apple owns the foundation. Wish rented the foundation from Facebook. And when Apple told Facebook to change the rules, Wish had 18 months to live. You're looking at the cautionary tale for the 2020s. Wish isn't unique. Thousands of businesses depend entirely on Facebook ads, Google ads, Instagram, TikTok, YouTube, platforms they don't control. Those businesses are one algorithm change, one privacy update, one regulatory shift away from collapse. Wish went from most downloaded shopping app to fire sale in 4 years. 14 billion to 173 million. Because Peter Sulkowski, brilliant as he was, built a palace on rented land. And when the landlord changed the locks, the palace disappeared. That's not bad luck. That's bad architecture. And the wreckage is still smoldering.